Another FOMC week down the drain, and we survived once again. The economy did not blow up. Let's go through the year to date performances. SPY is now down 19.77%. QQQ down 31.72%. IWM down 22.61%. And DIA down 10.04%. Dow Jones is still bullish trend, but it is right at Momo. It closed today, Friday, right at Momo. We did touch it, so it is getting close to flipping bearish trend again, joining the rest of the indexes. The system is still printing stagflation. No change there. We are still expecting chop. This is the regime that does not pick a direction, and both bulls and bears do not have a good time. So, calendar for next week. Main market moving events that we've got are happening on Thursday. We've got GDP and jobless claims. Those are the two things you want to be paying attention to. Jobless claims because that is what the Fed is looking for. They want the labor market to ease up. It's very tight right now. That's a big economic factor at the moment. And GDP, of course, seeing growth, how growth is performing.
Indeed. And let's go into CPI this week. So obviously the big headline of the week outside of the FOMC was the CPI print. We saw that come in lower on both core and headline and core, excuse me. But most importantly, out of all of this with the lower print, inflation remains extremely high. As you can see by the chart here, going back all the way to the 90s, we are still above and the highest print other than in the last 12 months. So we're still way above where we should be. So if this beats a little bit to the downside, market gets all joyful as we saw, but then everyone comes back to reality, realizing, well, the shit's fucked. So pretty simple until this starts really breaking down and getting down into into the zone where the Fed is eyeing it. Things will remain in the manner that they are right now, where people are just not sure if growth is going to rebound fast enough to save the economy, and that's where we are with the stagflation. If we were in a definite situation where growth was solid and solidly moving lower, we would see a more a more organized selling effort in the market to really push the market into deflation. But the fear is like, look, can growth rebound? We'll go over that in our video later this week about GDP and where that can go. But for now, all you need to know is inflation remains extremely high. Now let's go over the effective federal funds rate. It now stands at 433 basis points. The terminal, as of Friday, is 485 basis points. So we're still not at the terminal. Obviously, what this is telling you is we still have some hiking to do. It's not a lot. It's about 50 basis points as of right now. Where I'm getting a little concerned with this whole thing is the terminal right now is under the 2006, 2007 peak. So what that's telling you is rates are going to go up to about 485, stall out, and roll back down into the next recession where the Fed would be cutting rates. I don't know if this terminal is going to stick. We've played this game many times in the last 6 months where we watched the terminal literally rise 100 basis points in our face, and we've followed the terminal up from around 3 all the way to 380 to 4, all the way up to 5.5 or 5.25, and now we're back under 5. So the question now is, do we roll back, bounce back higher and go back into the low to mid fives? I just see the situation with inflation is obviously extreme, as you can see by the CPI chart, and I don't know if the same rates that were used in 2007, 2008 will suffice to cure this inflation problem we have now. Now, look, I know there's a big difference in time periods. Obviously, back then, the debt situation was much different. We're talking pre these big zero interest rate policy explosions. Now, the economy is a little bit different, right? But think of it like this: inflation is 7%, and the Fed funds rate is expected to be at 4.85%. And historically, we've done the work where we've illustrated, excuse me, the work where the terminal rate has to get above the rate of inflation to really fix the problem, at least within the Fed's eyes. So unless that happens, I don't think this inflation problem is going to be fixed. And more importantly, I think the Fed is ideally what they're trying to do is they're trying to hike rates at a pace where they can get it up there, not too quick, right? But just raise up that terminal up until maybe get into the fives, and they hold it there so inflation can fall back below that terminal and they can secure their quote unquote peak inflation theory. Now, let's go over what Powell said this week. Obviously, it's very important. Markets moved lower consecutively in the consecutive sessions after his speech. And what he basically said was that there was no rate cuts until they were confident inflation was moving towards 2%.
Well, I
So
mean
this
that
idea,
was already a given, right?
yeah, that was a
It's
given.
really not a surprise to anyone that's been paying attention.
Right. Yeah, no, that's a given. That 100% is a given. And then he's also said that he can't tell we won't move up the peak he can't basically affirm that they won't move up the terminal rate. And this goes back to what I just said a few moments ago where 485 may not be the peak. If we get to 485 in February or whenever we're expected to get there, I think it's excuse me, April, May, and this situation isn't really repaired. I mean, we're not under fives. I think we're going to see an issue.
Well, so why aren't markets pricing in a higher terminal if Powell came out and said that the terminal is likely not high enough? Does the market not believe him?
I don't think the market believes him. I think what ended up happening is a lot of people have been trying to chase this bond trade all year long, right?
Right.
And they've been getting smoked every single time. And for the terminal to go higher, right, we're going to need rates to go higher, and we're going to need the bond market, bond prices to go lower. I think bonds came off their lows and they set themselves up, and we spoke about this earlier this week, into this dovish, call it max dovishness, right? Everyone's thinking the peak in rates is in, the peak in inflation is in. Well, technically, yes, the peak in inflation is in, right? What I'm trying to explain is the peak in the terminal yield right now is 485, but that doesn't mean it's 485 a 1 month touch and we go back down to threes, right? We can get to 485 and we can hold there for 3 months. I mean, right now we're looking at like a 2 to 3 month hold at the moment. But if inflation isn't fixed by the time we get there, they're going to hold it there. As Powell said, that, where was it? He said that, I'm trying to think off the top of my head. I don't have it written down, but he basically said that they have no intentions of cutting rates anytime soon, right? So basically, what he's implying is, or what he's outright saying is, they aren't going to cut interest rates until inflation meets their target, and that's not going to happen until we start seeing the CPI prints under five, way well under 4%. So what I'm telling you is, if the time the terminal peak, or when the terminal peak is supposed to occur, if and when we get there at 485 and inflation hasn't come down enough, what's going to happen is it's just going to sit at 485. Now, if at the point at which we get there, right, inflation isn't isn't low enough to the point where the Fed's like, we could sit at 485. You understand what I'm saying, right?
Right. So
We can't
they
sit
might
here.
raise a bit more and
Right,
then sit
right,
at the higher number. So like,
right.
525 or something.
Right, and my whole point of, or my whole thesis behind this, is wrapped into the bond trade. Right, we've been saying this for some time. If we look at ZB futures right here, there's a good chance these goes chopping sideways and do nothing.
Mhm.
Right, and and,
Right.
and the
So
reason,
if rates are being held for a while, for a quarter or half a year, bonds are not going to do anything that entire time, essentially.
right, and we have to understand and we have to dissect the component um, of the yield behind the bond. Right, so let's look at a 2-year bond. let's just say we're expecting a recession, right? Typically, what ends up happening is people will chase the yield on out on the curve, 10 years plus because they want the best deal right now for the longest duration.
Right.
But that's because people are chasing those bonds, right? And there's a market pricing component. But what I'm trying to explain to you is out of the 2 year, or call it the 2 year treasury, right? The 2 year yield curve, right? So when we look at the twos and tens, the reason the twos are so steep compared to the tens is no one wants twos and everyone wants tens. The reason no one wants twos is because they think that they can lock in tens right now at a better longer term yield than twos. Because what ends up happening is when you buy a 2 year bond, you have a 2 year duration on that bond before you have to go out and reseek yield. The problem is and this is why people chase longer duration in a recession. The idea is, okay, 2 years from now, rates will likely be much lower, right? So the benefit of you refinancing that 2 year note 2 years from now will not be as good as what you can chase on a 10-year bond now for the next 10 years. And
Hmm.
the reason this ties into the whole bond pricing is the the bond pricing themselves on yields is focused around where the Fed's going to go with rates. And it's a bit of a complex topic, but to simplify it, think of it like this, right? If the federal funds rate sticks at 5% for 5 years, right? What is the yield on a 5 year treasury going to be?
Yeah, that'll be 5%.
Right. Now, what, or probably a little bit more, depending for the extra premium payments or whatever. But let's look at a 10-year bond, right? Now, let's just say I tell you that for 5 years, for 5 years, there's going to be a 5% federal funds rate out of that 10-year maturity. Where's the 10 going to go, right? Where's the 10-year yield going to go?
Right. So
And
it depends on what people are expecting. So if they're expecting the Fed to cut after holding that 5% rate for 5 years, then the 10 year is going to be lower than 5% because it averages out over 10 years at a lower rate.
right, but this is the issue, right, that we're going to run into here with the whole bond trade. So on that 10-year time horizon, if they're holding a 5% yield, yield on the bonds for 5 years, they would have to reduce the yield on the remaining 5 years a lot, right? Because if they reduce it even by half, it's only reduced by a quarter, right? Because the half of it was at 5%,
Reduce
right?
what?
So the federal funds rate. So if they reduce the
Okay.
federal funds rate by half, right? You're only reducing the coupon rate by a quarter because of that. The last 5 years have been X amount, right? The anticipation,
Okay. Yep.
right? So simply put, in the next 10 years, I expect 5 of those years for the Fed to hold a 5% rate. And then after that, for them to go to a 1% rate, right? Or call it a 2.5% rate, right? It's halved for them to half the federal funds rate in the last 5 years of that bond. In reality, that bond isn't going from 5 to 2.5 because half of that bond was at a 5% yield and the other half's at 2.5. So that's going to drop down in between 5 and 2.5. It's not going to go to 2.5.
Right.
You understand?
Right. Yep.
Right. So the problem with this bond trade is the longer the Fed holds rates at this rate, at the rate at which they're holding at right now, the longer that expectation gets priced into the market, the harder it's going to be to move bonds lower.
Right. So you kind of have this gravitational pull as time passes by at higher rates. It's pulling ZB down.
Right. And we can just look at it. We'll look at the 30 year for example. The 30 year is at 3.546, right? And this will really sum it up. Simply, the effective federal funds rate is 4.33, right? But we're only expected to see the peak somewhere out in 2023 and call it May, right? After that, we're supposed to the federal funds rate is supposed to roll over and come down. The longer that holds up, the more it's going to pull this higher because this is under that rate. Do you see that? If this holds up for another year, it's going to have 1/30th of an implication into this rate. You see what I'm saying?
Right. Yeah.
And obviously, we know that the market we're not going to wait a year to find that out. What's going to end up happening, as we saw earlier this year, the market will slowly pick up and say, look, terminal's going to stay hot. Terminal's going to stay glued for some time. And instead of getting a 2-month peak period, it's going to extend to 3, It's going to extend to 4. It's going to extend to 5 months out. As you approach it, it's going to get longer and longer and longer. Like, we're not going to get to May and think a rate cut's coming, and then they're going to just be like, no, we're holding rates. The market's going to figure this out before we get there. And what I'm trying to emphasize is that the market figuring this out before we get there, it's going to figure out that duration. If that duration is any longer than what we're expecting right now, rates are going to bounce.
Right.
And
Okay.
that's going to create a shitty environment for those that are chasing bonds right now, because everyone's thinking, look, everyone has this idea. We're going to hit May 2023. Fed's going to start reducing the federal funds rate. We're going to fall off a cliff, and the bonds will just go up to the moon. You know, maybe you got to weather a little bit more of a storm. And this is what they're thinking. Look, I'm buying bonds here, right? This is their mindset. I'm buying bonds here. What's my reward? This. What's my risk? This. Right? That's what
Right.
they're
And
thinking.
as soon as that risk changes and the terminal is actually much higher than people
Or longer.
anticipate, yeah,
Or longer. Right.
the whole game changes, and that's when we're going to see a move in bonds.
So this to simplify that risk thing, the risk scenario you explained, the terminal going higher hurts the leverage guys more than the terminal staying still. So if you're buying TLT, you don't really care if the terminal stays glued, right? Like, you're long TLT, you don't care if this thing chops. It doesn't matter to you because you're getting your coupon payment. You're in it. Like, what I mean is, you're long bonds for the coupon. The the um the the coupon itself isn't going to change that much if the terminal goes up 50 basis points.
Right.
Right? Like, you're still collecting a decent coupon. And if we were to look at the effective federal funds rate, as we just were, the difference between this 50 basis point coupon, or excuse me, the difference between where you are right now and 50 basis points higher is minimal. Like, you're still collecting a great yield compared to 12 months ago, right? So 12 months, your coupons are looking fantastic. You could care less. At that point, yes, you're right. Or those people that are buying it are right. It doesn't make sense really to worry if you're looking for that coupon. It doesn't matter. But the problem is if you're trying to do what we're trying to do and leverage long the bonds in the sense that you're going to capture the appreciation over the coupon, a move higher in terminals is very problematic.
Yeah. And so to wrap it up here, essentially bond trade is not here. Do you think we're gonna? You think the continuation of bonds and equities moving together is gonna persist? So now we're kind of seeing the S&P reverse back downwards. Do you think
Okay, that's a
bonds
good
will
question.
follow with that?
I don't. I think a lot of that. I think some of that correlation is going to wear off, and primarily because of this. Like, for the reason bonds and stocks had that positive correlation is because the Fed was basically hiking it. The Fed basically dragged interest rates up from 0 to 4 for 500 basis points where we're expected to go. That's pretty much 0 to 500, and growth was in the shitter. So 0 to 500 is going to destroy bonds, right? That's what's going to happen. Fed
Yep.
going from 0 to 500.
Yep.
Well, growth in the shitter is going to destroy stocks. We still have that growth problem, right? Where we don't know if growth is going to really rebound, and and we've been speaking about this. A rebound in growth might not be as substantial as the market would need to really push it into a risk-on regime. Obviously, we're risk off. We're holding risk off. The system says risk off. That's what we're doing. But I'm just saying, in the scope of what's going on right now, growth accelerating higher would only complicate the situation if it is at an extreme where it can push the regime into a risk on, right? Outside of that extreme risk on pivot, right? Outside of that, what you're going to see happen is you're going to have this negative growth effects, right? So stocks are going to still feel the pain. But bonds, on the other hand, well, that 0 to 500, we're already at 430, 0 to 433. So that 433 to 500 doesn't seem like that much anymore.
Right. So we're kind of on the tail end of the rate
Right.
hikes, unless obviously if some
Inflation.
new stuff
Yeah.
comes around, if inflation
Right.
really does get further out of control.
Right. And what I'm pointing to here on the ZB chart is like, look, think of like stocks, think of S&P 500 ES, right? Having the ability to go to print new 52-week lows and lower potentially, right? We don't know. We're still in risk off. And think of bonds if we get that term, if we hit that terminal for 2 or 3 months and we start rolling back. Think of bonds chopping in this zone right here.
Yeah.
It's not going to
So
feel the same as it did 6 months ago, where every day bonds and stocks getting smoked,
right.
but bonds still aren't winning. But I
Yeah.
think that's where we should wrap it up this week. And thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar, or go to our website and join our Discord at market-radar.com.